This is alarming. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, this will be worse than the 2008 subprime crisis, and it's already started. You're not going to believe where this next crisis is originating, and I'm going to show you why it's too late for central bankers to stop it. Plus, one of Wall Street's darlings has filed for bankruptcy. I'm going to show you why for this company, it's only going to get worse. We're also seeing a continued downturn in Asia. At the same time, central bankers remain completely clueless. And if you're wondering what we're doing at this shipping port today, well, as always, we're looking for demand and finding far less of it than the economy needs. Now let's head over to Bloomberg, where we picked today's story up as WeWork finally goes bankrupt, signs a pact with creditors to cut its debt. And of course, we know these companies are going to continue to seek out and reach restructuring agreements, because the issue here, it isn't just the debt. It's the fact that these companies just need a little bit more time, because as you know, the economy is about to hit a soft landing and surge higher. So of course, all these creditors need to do is give a little bit of extension here for the economy to turn around. But as we know, none of that is actually going to happen. Things for companies like WeWork are only going to get much worse. The company, which has 2019 peak commanded a whopping $47 billion valuation, listed $19 billion of liabilities and $15 billion of assets in its bankruptcy protection petition. It entered bankruptcy after reaching a tentative restructuring deal with longtime backer SoftBank Group and existing creditors to slash over $3 billion of debt and wipe out most of its shares. It's also seeking to reject more than 60 leases across North America and would use a court process to renegotiate other contracts. So here you can see, you look at money drying up in the economy. WeWork is a perfect example. They're trying to get out of existing leases that they clearly overpaid for. We know that prices for corporation buildings are coming down. They're going to need cheaper leases. This is all an issue of a lack of demand and a lack of money in the economy. The issue here for WeWork isn't that they're going through bankruptcy and they think they're going to come out okay. They might restructure, they might come out okay. The issue here is the economy is continuing to slow, and no matter what they do, they're going to be back in bankruptcy before anybody else realizes it. And sure enough, while WeWork reached a sweeping debt restructuring deal in early 2023, as I said, it quickly fell into trouble again. And so here the notion is that this is going to fix their problems. We keep kicking the can down the road into a slowing economy that's going to face an all-out banking crisis. And the notion that WeWork just needed more time and other companies will need more time. Of course, we look at China, which we're going to head over to in a bit. What do we see at the property developers? Just give them a little more time for the economy to turn around. What nobody wants to accept is, what if the economy doesn't turn around? In August, it said there was substantial doubt about its ability to continue operating. Well, we'll make the case this company's probably going to zero. Weeks later, it said it would renegotiate nearly all of its leases and withdraw from underperforming locations, leaving landlords in those places with nothing. Now, that's going to be a major issue. Again, we come back to these small mid-sized regional banks that are sitting on massive amounts of commercial real estate loans, and they're going to see empty buildings, no lease contracts, and we already know many of those banks are insolvent. And yet all hope is still being pinned on Asia. We've been making the case that the downturn there will continue, and we're seeing continued evidence that the global economy is slowing across the board. And yet China gives rare show of support to stressed developer Vanke, and yet we've noted that the property developers in China are in such dire shape, they need a bailout, because if they go down, and many of them are, we saw this already now with Country Garden and Evergrande, they're in major trouble. It takes down the entire Chinese banking system, and when that happens, it's going to flood out to the global banking system in a rapid way. It was only a matter of time before we started to see support from China, and sure enough, they got it. In an online call with financial firms on Monday, the city's state-owned Assets Supervision and Management Commission said it has confidence in Vanke and enough cash and tools to support the builder if needed. Now, I want you to note the key word there is if needed. So what you're seeing is a government agency come out and saying, you know what, we will support them if we have to. And all this is doing is providing confidence to investors and of course buyers that, hey, don't worry about Vanke, we've got their back. Now, of course, there's no expectation that they're going to step in and save this company, because there's no need to now, because Vanke's largest shareholder said it has no plans to cut its stake and is actively preparing to purchase Vanke's publicly traded bonds at the right time. So again, providing a lot of support here. And while regulators are unwilling to see defaults expand to other property firms, be they privately run or state-backed, the reality is there has been no significant improvement in property sales or financing channels. And that is the risk, is that these problems aren't one-off, that they spread to other developers, or here we see in the US, WeWork, it spreads to perhaps other companies that deal in the commercial real estate area who want to get cheaper leases or get out of bad buildings or bad leases. It spreads. The problem is we need to contain it. The issue here is we can't, because the global economy is slowing due to all of the central banker nonsense that we'll talk more about in a bit. And here we can see that nobody believes it, and yet China's economy is turning around as their import surprise offers hope as recovery risks linger. And that's what we're literally basing the entire global economy right now on, is hope that somebody from somewhere comes out and buys things. Right now, it's the U.S. consumer. As we go into the holiday season, there's a massive amount of hope that they come out and buy. We've made the case why they're not going to be in yesterday's show, but let's take a look at what's going on in China, because demand isn't exactly where you want to see it. Imports rose from 3% from a year earlier last month, the first gain in 8 months, and bucking the consensus forecast for a drop. But here's the issue: overseas shipments. Now, why does overseas shipments matter? Because China is an exporter. They're the world's largest exporter. So yes, they have a lot of people. They have internal demand, but there isn't enough internal demand. Now, there should be. On paper, there should be. It's just not. So when we look at China's data here, all we care about is one thing, and that's exports, because it tells us what's going on with the rest of the world. And those exports dropped 6.4% worse than expectations. The data underlines the fragility of the recovery in the final 3 months of 2023. Import growth suggests domestic demand may be recovering, which is true, but the decline in exports was a big disappointment for a period that should have been more favorable. And why do exports matter? It's not just about the global economy, but how does China get dollars? Remember, we talked about, Country Garden, the property developer. What are they defaulting on? Their dollar-denominated bonds. This is an issue here. China needs dollars. They're starved of dollars. And yes, you can see domestic demand increase a bit, but if global economy doesn't turn around and you don't see global demand turn around, well, what's going to happen is internal demand to China will drop as well. Because where do you think a lot of these people work? They work at factories and other businesses that do what? If you said support the global economy, you got it right. And here we can see that this was a big disappointment, because this October compared to a month in 2022 when the pandemic and controls contained it disrupted logistics and production. So we're seeing that the global economy continues to slow. And look at this, to the U.S., exports declined 8.2% in the first 10 months from a year ago in dollar terms, and while that to the European Union dropped a whopping 12.6%. And so all that tells us is very clearly global demand is declining. The global economy is shrinking. This is exactly what we would expect when central bankers invert money curves and yield curves and cause the banks to constrict the creation of new money into the global economy. This is all to be expected. But wait, we'll show you just how clueless they are and why everything you're seeing here is going to kick off the next subprime crisis in the U.S. Now let's head over to Japan, where their wages and spending extend declines. In a test for BOJ policy, keep in mind that the Bank of Japan maintains fairly loose policies there compared to the rest of the world. But one thing that shouldn't be experiencing a decline, well, that's your trading account. Let's give you an update on a trade we talked about a long time ago. Let's take a look at soybeans. I want to show you just how easy these reports are used. Now, our CTA Timer Pro looks at machine positioning and tells you when they reach an extreme position. We tell this to our subscribers. These are the ones to watch. When it flips, you want to buy it. On October 11th, soybeans were on October 10th, they were at max 100% short, and they flipped on the fast algorithm on the 11th. That's key symbol number 1. Now, they could have traded it, or they could have waited about 5 days until Momentum Timer Pro. This looks at technical analysis signals. All of those, things like the MACD and the RSI we put them all together, smooth them out. And on the 16th, we got a 1 daily count on the technical signals that said to buy. And so you now have what's called the paired trade. You've got CTA and Momentum Timer Pro giving you the signals you need. And if you put that on trade on soybeans, well, you'd buy it open on October 16th. You see that little green candle there. And sure enough, right now, you'd be up 5.57% on that trade. Just that easy. Now, I put on 5 more coupon codes for a free month for both of them. Remember, you got to grab them quick, try them out, month on me, and then you can see the power of these two reports. But let's go on to Japan because things there are getting much worse. As financial markets worldwide pay close attention to the wage trends in the world's third largest economy, the Bank of Japan regards sustainable pay increases as one of the prerequisites for unwinding its ultra-loose monetary stimulus. As inflation-adjusted real wages, a barometer for consumer purchasing power, dropped in September by 2.4% from a year earlier after a revised 2.8% fall the month before. So what we can see is inflation-adjusted wages are dropping. We know what that means, less discretionary spending. And you start to see this trend all around the world. We see it here in the U.S., we're seeing it in Asia, we're seeing it in Japan, we're seeing it all over the world that their wages are not keeping up with inflation, and that leads to only one thing, and that is less spending. Meanwhile, household spending here, you see it decreased 2.8% in September from a year earlier, falling for 7 months in a row. It was roughly in line with the estimates. So again, things in Japan getting worse, things in China getting worse, things in the U.S. getting worse, and yet central bankers remain completely clueless, as you're about to see. And of course, it is their behavior, their actions that are going to lead to the next crisis here in the U.S., which has already started. As Fed's Kashkari said, that it's too soon to declare victory on inflation, making us wonder, why is he in such denial about what's going on here? And earlier on Monday, Kashkari said the risk of over-tightening monetary policy is preferable to doing too little. And he's concerned that inflation could tick up again. Now, of course, we've made the case that inflation-adjusted wages are going down, total compensation is going down. The notion that we're going to see an uptick in inflation is highly unlikely. But I want you to go back here. Let's look at what he said. Very key words here. That the risk of over-tightening monetary policy is preferable. So what he's admitting here is he'd rather see the U.S. economy going into a recession. He'd rather see layoffs increase rather than see inflation turn around, which we already know isn't. Under tightening will not get us back to 2% in a reasonable time, suggesting they're in a rush to crash the U.S. economy. And sure enough, they can't see it that they've already over-tightened. Here we have the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. That's shown in blue. And anytime it's above that horizontal black line, the banks are on net tightening. On the way up, they're tightening at a faster rate. On the way down, they're tightening at a slower rate. We've got that overlaid with the U.S. Consumer Price Index, that on a year-over-year rate of change. And what do we note? As banks tighten standards and they constrict credit, and that means less money is created in the economy, inflation comes down. You see it happen every time. It's coming down in a big way. Now, granted, they're saying not as fast as they want. Well, if you want it faster, Kashkari, I got one answer for you. Have a financial crisis, but you already know that's coming because the small and mid-sized regional banks, they're completely insolvent and are 100% dependent on you. Even Fed's Goolsbee says inflation is top goal. He won't prejudge rates. You got to get inflation down. He says that's the number one thing. I'm absolutely hammering that's what we should be watching. Adding economic and job growth can't be the key focus now. So here you can see again, economic and job growth can't be the key focus, being they're willing to sacrifice the economy. They're willing to sacrifice jobs. They want to bring inflation down. The problem is they don't realize that when they do, it's going to lead to a massive recession and a financial crisis. The problem is they just can't see it. And we're already seeing the early phases of the crisis, the next subprime crisis here, start in the U.S. Meanwhile, Goolsbee repeated comments made last month that the Fed can continue down the path that he calls the golden path to a soft landing. We'll just say we're not sure what he is looking at, but the data, as you just saw, look at WeWork, look at what's going on in China, look at what's in Japan, and wait till you see what's coming in the U.S. here, what's already started. The notion that we're going to have this golden path to a soft landing is completely unrealistic. Yet U.S. trade deficit widened by more than forecast on goods demand. So even though we saw demand coming from China to the U.S. decline, we actually saw a little uptick in demand in the data. But will it last? Well, the answer is no. The shortfall in goods and services trade expanded 4.9% from the prior month to $61.5 billion. The value of imports rose to the highest since February. And while exports increased to more than a one-year high, the figures, keep in mind, aren't adjusted for inflation. So that's an issue here, suggesting that the optimism may not be as much as the actual data says. But the issue here is when we look at imports of goods and services, as shown in blue, continue the theme with the consumer price index in red, both shown on a year-over-year rate of change. What we know is where imports go, that of course the consumer price index falls. And why Kashkari and Goolsbee are worried about a rebound in inflation, there's nothing about this import data that suggests otherwise. In fact, we can go back here in the 70s and see that imports went rising and that took inflation up. That was the issue. There was indeed demand. Today we don't have that demand, and yet central bankers clearly believe it's coming out of nowhere. And now let's take a look at the next subprime crisis is starting here in the U.S., and it's going to be even worse than, of course, what we know as the housing subprime crisis. As the S&P now warns about subprime auto bonds from its flagship car finance, as rating firms point to worse than expected performance. Now, this should be of no surprise to us. We've known that people during the pandemic bought a bunch of cars that they couldn't afford. We know the data says that a bunch of people have car payments over $1,000 a month, if you can imagine. So you think about this. When the economy slows and money tightens up and people have these cars, what are they going to do? Well, they're going to give the keys back to the bank. We're going to see a lot of these small, mid-size, and even credit union car lots turn into used car dealerships because they're not able to handle all of these vehicles that are coming back that they lent money against. And yet we see in the data here, check this out, that not only has the crisis started, but it was easily something we already predicted would come. An acceleration in losses in the past few months is calling into question previous ratings upgrades for 4 of the issuance. Total net losses in all 6 transactions have jumped more than 3 percentage points since the beginning of the year through October. So what we're seeing is, of course, these subprime auto bonds are starting to fall apart, much just like those mortgage-backed securities started to fall apart heading into the global financial crisis. And look at the catalyst for this. Other indicators, including delinquency rates, which we talked about in the show the other day, also increased in all but 1 of 6 transactions. And what have we made the case is that when delinquencies increase, it's a sign that there just isn't enough money being created in the economy to sustain growth and pay on all the debt. And there it is in the subprime auto space. And you think this time, if people are going to pay on their car instead of their home, not a chance. When they lose their job, they're not going to need their car anyways. They're going to turn it in to the banks. You'll watch and see. And yet we have now even more demand. The global economy is slowing. This we turn to FedEx. As FedEx suggests pilots fly for American Airlines as cargo demand slows. That's right, they're telling their pilots, hey, you know what? You can't fly for us because we don't have the demand, but why don't you go over to American? They've got a demand for pilots and they'll promote you right away. And look at this from FedEx. Given the softness in air cargo demand across the industry and current FedEx flight operation staffing levels, we share information about this unique opportunity with our pilots to go work for another company. And there is all the evidence you need to see that not only is a global economy slowing, but of course, we look at what's going on with WeWork in the commercial real estate market. We look at these subprime auto bonds, and we can see it's just a matter of time before something blows up, and it's coming much sooner than any of the central bankers think. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.